Right. So you've learned to value the security. Now, let's come to the cost of capital. Cost of capital, as the name would suggest, is the cost to the company for the capital that they are raising. And the capital here are the long-term equity capital or the long-term debt capital. Remember the diagram I drew when we're trying to look at what how the funds are or how funds are located within the financial system, right? And I mentioned that if a company borrows money, we have to pay a cost to the intermediary who will then revert or pay some returns to the surplus fund holders. And so it is for us to know how to calculate the cost of our capital. And like always, we are going to start with equity. So let's know how to calculate the cost of the company's equity. Now let's come to the formula sheet, as I always like to do. So we have it here. So you see cost of capital, and these are the formulas. Please let's pay key attention to what we are going to see over here. Now, you see KDT, this relates to debt. Then you come and see KE, and then KE. This is basically cost of equity. Okay? And then there are some other formulas here. We'll get into all of them. Then we finally have what? WACC. Okay. Let's turn to equity and look at it first. Now you see, the formula is very, very similar to something you've seen before, but don't get confused. When we're looking at valuation of equity, okay, the formula we used was that we were finding P0. So P0 was what was equal to D0 into bracket 1 plus G all over what? KE minus G. Now we are looking for this. So we have just taken this formula and we have made this the subject, and that is what you are going to get here. This class, we are not here to prove the formula to anybody. The formula is there in your formula sheet. Just know how to apply it. That is all. Okay? All right. So KE, which is the cost of equity, is equal to D0, 1 plus G, over P0 plus G, where KE is the shareholders' required rate of return or the cost of equity. D0 is the current dividend. P0 is the current share price, which, again, I told you, should be the ex-div. And then J is what? The growth rate of what? Of the company's dividend. Simple as that. All right. Now, earlier, no, you were given the growth rate in the company's dividend. But what if you are told to what? Calculate the growth rate in the company's dividend yourself? And this is where I also want you to pay attention. We have two ways of doing it. Now, when you check the formula sheet, you can also see that they've given you what? J. And then J, we have one formula for J, and then we also have what? A second formula for J. All right. So we have using the past dividends of the company, using the past dividends. Okay? By using the past dividends of the company, we can be able to estimate or project what the growth rate in the company's dividends are. And the formula basically is the nth root. Now, in the nth root, it says current dividend, which I have in my lecture notes, or per the formula sheet, it says the last dividend in the series. We'll look at what that means. Over, in the formula sheet, it says the first dividend. In my lecture notes, it says what? Dividend years ago, or here it says the first dividend in the series. So you are given a series of dividends. Okay, so the first and last, that is what it means. -1. That is the first way of calculating what? The growth rate in the company's dividend. The second approach is what we call using the RB model. Now, the R in the RB model stands for what? The return on reinvestment. All we are saying is that if the company makes profits, they pay out some as dividend and retain some as what? As reserves. Now, the ones that they retain as reserves, they use it towards undertake developmental projects for the company to grow. Now, the return on the amounts they have reinvested is what they have given to you as a percentage. It could be 20%, whatever it is. Then that return on reinvestment by the retention ratio. So the retention ratio is what proportion or what percentage of the company's profits do we retain? That is the retention ratio. The other proportion which we pay out as dividend is what we will call the payout ratio. That is all. Okay, so the dividend ratio, the pay or the retention ratio by the return on reinvestment. When you multiply the two, that will give you what? The growth rate in the company's dividend. As simple as this. Simple. Okay, so the next set of questions you are going to solve is to learn how to calculate the company's cost of equity, where we'll be told to calculate the growth rate and then so on and so forth. All right. So let's get back into the question. The question set we have. Let me pull that out. Cost of capital. Last that you were asked to calculate what we call the weighted average cost of capital, WACC. Okay. So when we finish with the individual capital sources and we do WACC, we may even look at that question, that last diet question. Okay, everything is straightforward and intertwined. Okay, let's get back into the. Even if I'm done with cost of debt, I think we can close the class. Okay, so don't worry at all. We'll close very soon. All right, we have costs of capital. We have what? Equity. That's what we are starting with. So let's find KE, which is the cost of equity. Okay, so Sun PLC has an issue 1 CD shares with a market value of 2 CD 40 pesos per share. A constant dividend of 30 pesos per share has just been paid. What is the shareholders' required rate of return and therefore the cost of equity to the company? Now, the question has put it this way because you see, when it comes to equity, note that what the shareholders will call their required rate of return, RE, it is the same as what the company will refer to as what? Their cost of equity. So RE is the same as KE for equity finance. And so therefore, KE or RE will therefore be equal to what? D naught 1 plus G over P naught plus G. And this one, there was no growth rate, right? Hey, there was no growth rate too. I've chosen the wrong formula. Pardon me. All right. So this will basically be the how we get the cost of equity. Okay. So it will be the dividend per share, which is 0.3. Okay, remember. So please, choosing the right formula is also very important. Dividend per share over the current share price, which is 2.4. And that therefore will give us how much? 0.3 divided by 2.4. So 12.5. So that is 0.125, 12.5%. Right. Example 2. TPLC has an issue 50% shares with a market value of 4.2. A dividend per share has just been paid. Dividends are growing at 6% per annum. What is the cost of equity? So because there's now a growth rate in the dividend, it therefore means that the cost of equity will now use this formula. D naught 1 plus G over P naught plus what? Plus G. Kindly hold on for me for just a minute. I'm coming. It's about to rain. Coming. Okay. All right. Let's proceed. So the cost of equity will therefore be the dividend per share, which is going to be 0.4, right? Into bracket 1 plus the growth rate, which is 6%, all over the share price, which is 4.2 plus the growth rate of 6%. And so I believe that will give us 16.1%. 16.1%. Let's look at example 3. UPLC has an issue 1 CD share with a market value of 3.6. A dividend of 30 pesos per share has just been paid. Dividends are growing at 8%. What is the cost of equity? So also same, cost of equity will therefore be dividend per share of 0.3 to bracket 1 plus growth rate of 8% all over current share price of 3.6 plus 8%. And that'll give us a cost of equity of punch 17%. Okay, 17%. All right. So with the first 3 examples, it's very straightforward. Let's look at the fourth one. Now, with the fourth example, what do we see? The year is now 2001 currently, and BIT Co has paid out the following dividend in past years. So we have information on what the company's past dividend payments. The question says, let's estimate the average growth rate of the company's dividend. So please don't go and add this plus this plus this plus this plus this and divide by 5. No. When you see something like this, the approach we are going to use is what? Is by using the past dividend payments to estimate the growth. And so J here will be the nth root. So using the formula, right, this one will be the last in the series. So this is what it means. Last in the series, or the current dividend, over the first in the series. Minus 1. Now, for me, my main issue is how to get this n. Now, you see that in some books or when you are solving questions, the n, they've done it n minus 1. Okay. Now, for the n minus 1, what they mean is that 96, 97, 98, 99, 2000. That is 1, 2, 3, 4, 5. So that is 5 minus 1. Okay. So for them, n is 4. Similarly, others can look at it this way. So 96 to 97 is 1 year. This is 2. This is 3. This is 4. So whether you are doing it what I've done here, or you are counting it one by one and subtracting 1 from it, your n is supposed to be what? 4. Okay. Now, in your lecture notes, I say the numerator is the current dividend. So when you check it, the most recent dividend is what? The 33. Now, when you check your formula sheet, it says the last in the series. Out of the series of dividend, this is the last one. So you can see that you are going to arrive at the same thing. Okay, so 33,000. All right. Then this is first in the series. So this is the first dividend, first one. So that is 28,000. The lecture note says dividend some years ago. So the very first one, this. Then whatever you get, minus 1. Okay. So that is going to be the growth rate. And when you punch everything, you are supposed to get a growth rate of 4.2%. So that's basically about that. This is estimating the growth rate using past series in dividend payments. Okay. All right. Let's look at the next one. Example 5. YSL PLC pays 40% of their earnings each year as dividend. And they require a return of 20% on reinvestment. What is the expected growth rate in their dividend? Now, the 40% is what we call their dividend payout percentage, or the dividend payout ratio. Now, when we want the retention ratio, it will be 100% or 1 minus what? The payout ratio. So that will be what? The remaining 60%. And so the retention ratio is what we refer to as the B. And then the R is the return on reinvestment. And the question says that is 20%. So using the RB model, so this is the RB, okay? RB model to estimating the growth rate. The growth rate will therefore be 60% by 20%. And that gives us 12%. I hope you are all on the same page. All right. Then let's go to question 6, which will cap everything that we have done so far on equity. Zen PLC, Zen Ghana, or Zen Petroleum, right? So Zen PLC has in issue 1 cedi shares with a market value of 2.8 cedis per share. A dividend of 20 pesos per share has just been paid. Okay, so the dividend is 20 pesos per share. And then they also gave you what we call the earnings per share of 32 pesos. So you know we have EPS, earnings per share. Then we have DPS, dividend per share. So out of your earnings, you pay what? You pay dividend. Okay. The company is able to invest so as to earn a return of what? 18% per annum. A. Estimate the rate of growth in the company's dividend. And you see, based on the information presented to you, to estimate the growth rate in the company's dividend, you know that it is either I'm using the past rate of what? Dividend payment, or the past growth in dividend payment, or I'm using the RB model. Per the information we have, the applicable approach towards calculating the growth rate is what? The RB model. So it is just up to you to determine what the retention ratio will be and what the return on reinvestment will be. Now, in this question, we have to look at it with a close eye. If I am making an earnings per share of 32 pesos, and out of it, I am paying a dividend of 20 pesos, then it means that the remaining, I believe, 12 pesos per share is what I'm retaining. Okay? So the retention ratio, we can say, is 100% minus, so you can go about it in several ways. So 100% minus the payout ratio. So the payout ratio will be 0.2, which is the dividend per share, over the earnings per share, which is 0.32. Okay? So this will give you a percentage. When you subtract 100 from it, it will give you what? The retention ratio. So 0.2 divided by 0.32, that I believe is 62.5%. Okay, 62.5%. So 100 minus 62.5, 37.5%. That is the retention ratio. Then the return on reinvestment is 18%. And so our growth rate will be 37.5% by 18%. And that gives us a growth rate of what? 6.75%. Please cross-check all that we have done so far. B. Calculate the company's cost of equity. And so therefore, KE will be equal to D naught 1 plus G all over P naught plus G. Now we have dividend per share to be what? 0.2 into bracket 1 plus the growth rate which we have calculated, which is 6.75%, all over the current share price, which we are told is 2.8, plus the growth rate of 6.75%. And that therefore gives us a cost of equity of 14.375%. Now, C finally says, estimate the market value per share in 2 years' time. Now, one thing you need to understand is that by looking at the growth or how the company's dividend is growing, it can also give us what? An idea of how the company's share or the share price or the company's earnings will also what? Will also grow. Okay? So the growth in the company's dividend or the rate of growth in the company's dividend is a perfect estimator of how their share price can also what? Grow. And so therefore, the share price of the company in, let's say, 2 years' time, right, will be the current share price, which is P naught by 1 plus the growth rate raised to the power what? It says 2. So currently the share price is 2.8, and that will be into bracket 1 plus the growth rate. The growth rate is 6.75 raised to the power 2. And that'll give us a share price of 2.8 by 1 plus 6.75 raised to the power 2. And that is 3.19. Supposed to be cedis, or is it dollars? Okay, it's cedis. Okay. I hope that is clear. So when it comes to cost of equity, as you saw in the formula sheet, knowing how to estimate the growth rate in the company's dividend and also knowing the applicable formula to use to estimate the cost of equity is all that there is to it. Now, we are going to learn later that there's another approach to estimating what? The cost of equity, and that is the CAPM. So once you have that under your fold, you know that, oh, if I see a question, when it comes to calculating the cost of equity, there is this approach, which we have just done now, and there's also what? The CAPM approach. So last night, in one of the questions, we were told to calculate the WACC, or I think the cost of equity or something like that. Then, per the information given you, the CAPM approach was what? The best way to go about what? Calculating the cost of equity. So for cost of equity, we have all that we have done. This one, okay, using the dividend approach. So we either use the dividend approach, which is what we have done, or we can use what? The CAPM approach to calculate the cost of equity. Please note this. Okay, please note this. All right. So let's get back. Let's get back to our question or our lecture notes. So all of this for what? Equity. Now, cost of debt. Cost of debt. Now, when it comes to the cost of debt that the company will have to pay, we are saying since the company enjoys what we call tax reliefs, okay, as a result of the finance cost they pay, it helps to reduce their cost of debt. And so rather, we'll be looking for what we call the after-tax cost of debt. So in your formula sheet, you can clearly see that at the debt portion, it is mentioning KDT, 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 and you know, KDT. So after tax cost of debt. So the T here represents what? The tax, after tax. That's what. All right. So we said we have two types of bonds, the irredeemable one and then the redeemable one. So if it is irredeemable, then your guess is as good as mine. The way you calculate it is what? The after-tax interest or coupon over the market value or the price of the bond. So this is it. That's all. Straightforward. When you come to the formula sheet, I have the same thing here. The coupon into bracket 1 minus T, which is the after-tax coupon or interest, and then the MVD or PO, which is what? The market value of the debt. Straightforward. However, when it comes to the redeemable approach, the question tells you, or even your formula sheet tells you that we have to use the internal rate of return of what? The future cash flows of the company. Now, for me, this approach is very long. Right? It's too long, right? Look at it here. This formula you are seeing here is the internal rate of return. Okay? Internal rate of return. All right. It's too long. So there is a formula that I'm going to give you, right? And that formula is very straightforward. Once you use the formula, you are going to get the same thing when it comes to what? Calculating the cost of debt for a redeemable debt. All right. And what is this formula? The formula to get KD1 minus T is equal to I1 minus T by the redemption value, since a redeemable debt, minus the price of the debt or the market value of the debt, right? Whichever way you want to call it. All over N. N here being what? The maturity period of the bond, since it's redeemable. Then we have 2 times, all over 2 times, the price of the debt, which I'm representing as PO, plus the redemption value, all over 3. So this is the formula. When you input your whatever it is, you are going to get what? The after-tax cost of debt. And it is the same as what? Using the IRR approach, which is very, very long. Okay? So I'll urge you to remember this or to use this formula. All right. So the last thing we are going to do for this session is to calculate the after-tax cost of debt of the company. Then in our next meeting, we'll look at what? The WACC, the weighted average cost of capital. All right. So let's go to our question set. And then finally, look at what? The cost of debt finance. Let's see if there's something else. Okay. That's this comments. So after tax cost of debt. Okay. All right. So example 1. FPLC FPLC has in issue 8% irredeemable debentures, which are quoted at what? 90 cedis. So this is the market value. 1, it says, what is the return to investors? So this is KD, right? Okay. And then the second one says, what is the cost to the company if the rate of corporation tax is 30%? So that is the after-tax cost of debt. So please remember that for debt, there's what we call KD, and then there's also what we call what? KD1 minus T. This is to the investor. This is to the company. However, for equity, RE, right, which was the return to the shareholder, and then KE, which is the cost to the company, were the same thing. But for debt, the two are different. So this is not the same as what we have here. Because for the company, we are factoring in what? The element of taxation. I hope the difference is clear. Okay. So let's look at the cost of debt. So for the first one, it is irredeemable. So for irredeemable, ICs calculate KD, which is return to investor. And for the return to investor, it is very simple. It is just the coupon or the interest over the price of the debt or the market value of the debt. And that will be 8% times the nominal value of 100 all over 90. So that is 8 over 90. And that will give us 8.89%. Okay, that is to the investor. But using the same information, if we want to find the cost to the company, which is KD 1 minus T, okay, that is costs to company. Then the formula becomes I into brackets 1 minus T all over what? The price of the debt. So that therefore means 8 into bracket 1 minus the taxation rate is 30% from the question all over 90. And that will give us 6.22%. Okay, 6.22%. All right. Then we'll look at example 2. For example 2, the type of debenture we have here is a redeemable. Okay, it's a redeemable debenture, a redeemable debt. JPLC has an issue 6% debenture quoted at 85 cedis as the price. The debenture is redeemable in 5 years' time at a premium of what? 10%. What is the return to the investor? So also, we're going to do KD, and then what is the cost to the company, which is KD 1 minus T. Now, the formula I showed you is what we are going to apply. So for KD, this is what will happen. For KD, it is going to be I, which is the coupon, without taking out the tax, plus redemption value minus the price of the debt, all over N, everything over 2 by the price of the debt plus the redemption value all over what? 3. But when it comes to the second one, which we are going to look at, which is KD 1 minus T to the company, then KD 1 minus T will be, now the difference is always with the coupon or the interest. This one will be the after-tax interest. Okay, so 1 minus T plus RV minus price of the debt over N all over 2 times the price plus the redemption value, everything over 3. So the stage is set. To the investor, the return that they are going to get is 6% by the nominal value of 100, right? So that would be 6 as the coupon, plus the redemption value is at a premium. So 10% on the 100, right? So that would be 110, just like an earlier example that we saw, minus the current price of the bond, which is 85, over bond will be redeemed in 5 years' time, so over 5. All over 2 by 85 plus the redemption value of 110 all over 3. Okay. All right. So I have a video on how to punch this, which I'll share with you later. So do not worry. Then for the cost to the company, which is the after-tax cost of debt, here, the interest, we are going to take out the tax component from it. So rather than it being 6 cedis, okay, as the coupon, it will rather be 6 into bracket 1 minus the corporation tax, which we're told is also 30% here. So 30%. So plus everything else will remain the same.